Well, good afternoon, everyone. Welcome to Dorsey and Whitney's webinar on preparing for the 2023 SEC reporting season. I'd like to introduce to you Kimberley Anderson, a partner in Dorsey's Corporate Governance and Compliance Group. Kimberley?
Hi, everyone. We really appreciate you taking time today to discuss with us the what's new for the reporting season. So I'm delighted to be here, as is my co-presenter, Kim Hoang. We have both been doing this for a while now. As Matt noted, my bio says I have over 20 years of experience doing public company and capital markets work. One of my partners noted that it's actually close to 30 as of next year, so that's a little out of date. But I am still co-chair of the Capital Markets and Corporate Compliance Practice Group, and I'm delighted that Cam is able to do this with me. Let's be clear, she does the lion's share of the work. But Cam is also in the Capital Markets Practice Group. She has been a partner at Dorsey for several years, but she was also previously senior counsel and assistant secretary at General Mills. So she brings another kind of practical in-house element to these presentations, which work really, really well. So again, we want to, thank you for spending the next hour with us. So the program today is about 60 minutes, and the materials will be circulated after the presentation, and they'll be available for download. And then you can also return your attendance form, as noted on there, to attendance@dorsey.com. If you have any questions, we haven't really made time for much of a Q&A session, but you can, of course, always reach out to either me or Cam or to any of your trusted Dorsey advisors. So, with that, I think we will jump in. Just very briefly with respect to the agenda. We're first going to be talking, normally we talk about the 10K first, and then we jump into the proxy because that's the order that they're normally filed. However, this year, all the fun stuff's in the proxy. The 10K is kind of an afterthought in many ways. So we're going to start with the proxy to make sure that we have adequate time to go through it, and then we'll go through the 10K afterwards. So Cam is going to be leading us through the discussion on the proxy. Cam?
Well, as always, it's a real pleasure to be co-presenting with Kimberley on this, something I really look forward to. So this year, the SEC gave us all a nice early Christmas present when they finalized the pay versus performance rules, right? And so I'm sure many of us on the call have been working diligently to make sure that we're prepared for the proxy statement, because it will be in the 2023 proxy statement. And it applies to all reporting companies except for foreign private issuers, registered investment companies, and EGCs. Smaller reporting companies get a little bit of reprieve because y'all get to provide scaled disclosure, but still you will need to comply. Suppose a silver lining is not incorporated by reference into any other filings, including the 10K. And companies will have to make a conscious decision whether or not to include it inside the CDNA. And the SEC gave everyone this option because they believe mandating the disclosure in the CDNA might cause confusion by suggesting that companies actually consider this analysis and this relationship when they're making their compensation decisions, which at least for this year may or may not be the case. So, the stated intent of the rules are really to help investors better assess executive compensation when making voting decisions, for example, when they're doing their say on pay vote. And these rules have been a long time in coming. Kimberley, do you have a sense for whether investors will actually be incorporating the disclosure into their analysis this year? And I'm also kind of curious to know what type of questions you're getting from your clients about them.
So we'll take the easy one first, which is what kind of questions. Some of them are still shell-shocked. We know some clients have actually hired consultants to help them actually work through the actually paid adjustments, because that's really where some of the detail is, or actually that's where a lot of the detail and the pain really is. Everything else is simpler. In terms of investors, I think a lot of large investors already do some of this analysis anyway. What this does do is it provides this analysis for either smaller investors, retail investors, because I think a lot of the major investors consider this already. Now, I will say one thing about this. adding in more and more mandated disclosure, I think just gets hard for companies, but at least this one actually has a point. You know, the CEO pay ratio. Okay. I hated that rule. I considered it to be, okay. I never actually thought that there was actually much use to it. I didn't think it was actually particularly helpful for any investor. Just based on the way it was, it depends on your industry and everything else. It mostly seemed to be built just for purposes of putting something in a press release, and never in a good way. But this, I think, actually has some validity to it, because it really goes to, you know, how pay changes, you know, in connection with the company's performance. But I'm gonna get off my soapbox and kick it back to you, Kim.
Yeah, well, I think that's an interesting insight to say, hey, look, you know, your large institutional investors, they have their own analysis already, but what about the smaller ones, right? Are they going to be paying closer attention to this? And it might be worth a conversation with them as you do your annual shareholder engagement. Say, hey, you know, how are you thinking about this pay versus performance analysis that's now mandated? So one piece of it, there are about three big pieces. So one of the pieces is pay versus performance table, which disclose specified executive compensation and financial performance measures over 5 years, 3 years for smaller reporting companies. And when we send you our supplemental materials, there will be a template with some explanatory footnotes to help those of you who haven't started down this path yet. And, you know, the table is really focused on the SEC's definition of compensation that is, quote unquote, actually paid. Now, actually paid to me suggests that it's a realized pay concept. But as you dive more into the definition, you know, we think it's more of a realizable pay concept. And, you know, it's based on the total compensation that you're going to find in the summary compensation table, but there are adjustments to pension values and equity awards. And the adjustments to the equity awards are going to require companies to calculate the fair value and changes in fair value of outstanding awards, you know, both at fiscal year end and then as of each vesting date. And it is actually quite time intensive, and it's going to require quite a bit of effort. And so, Kimberly, when you were saying, you know, there are companies that are bringing consultants into the mix here, I think that's part of the reason why, is because these equity awards are fairly labor intensive, the value to calculate. Now, in terms of the financial performance measures that are also going to be included in the table, I know one question that our clients have been asking is, hey, you know, should we decide, how do we decide which peer group to use in the peer group TSR calculation? And so you can either use the one that you use for your stock performance award graph, that's prepared every year anyway. Or you could also use, you know, the peer group that you use for your CDNA, and that's used for compensation benchmarking. And so in some respects that makes sense. But, you know, if the peer group is not a published industry or line of business index, then the identity has to be disclosed in a footnote or incorporated by reference. And furthermore, if the peer group changes from year to year, then you have to footnote the reasons for the change and to compare the TSR, both with the newly formed peer group and also the prior one. And so that's perhaps one tip to the scale to say, well, let's use our industry group, because if we use our compensation peer group and then it changes year to year, it will require a little bit of thought in terms of putting together a footnote and then putting together additional TSR disclosure information. So Kimberly, I don't know if, you know, your clients have talked about that, or, you know, are they kind of mulling that?
I think they're still mulling that over. I mean, let's just say the first and most natural response is going to be, if you have, like, you know, when your peer group for compensation purposes, if it's a very stable group and if it's a group that you don't anticipate doing many changes, I can see the natural response would be like, let's run the numbers and see which one looks better. But if you're someone who actually, you know, realizes and really makes modifications to that peer group for many very, very valid reasons, they can switch around. It may make more sense, because otherwise, just to use what you use for your performance graph, because otherwise I think it would become harder and just more confusing when you're constantly having to show those adjustments. So, I mean, as you said, I think, you know, anticipating any potential changes if you make your own peer group could be harder to do, and just, you know, add additional layers of work.
Yeah.
So,
and something you said really strikes a chord. I mean, I'm a big fan of modeling. So we know it'll change year to year, but show your executives, show your board what this actually is going to look like.
Right.
Well before it actually makes it into the proxy statement. Another element of the table is this company selected measure, which is a financial performance measure that the company would pick that's specific to the company and in its assessment represents the most important financial performance measure that the company uses to link compensation actually paid to the NEOs to company performance. And just the one thing I would note about this is that the SEC does acknowledge that this CSM could change from one filing to the next, right? And another note is, companies can supplement this tabular disclosure, for example, with graphs or additional narrative. But the concept to keep in mind there is that the additional disclosure should be clearly identified as supplemental and not misleading, and it shouldn't be presented with greater prominence than what's actually required in the disclosure.
So Cam, question for you, and then we can go on to some of the descriptions. But when companies are trying to decide the company selected measures, what the modeling looks like, I expect that this would be something that they would be talking with the compensation committee, in depth about getting the compensation committee's input, because they're in fact, very, very much involved in the process when it comes to pay procedures. And have any of your clients started, reaching out to their comp committees, or are they primarily working with the chairman? Do you have any sense of it, or is it very highly dependent on the company?
Yeah, I agree with that. Definitely clients that I've worked with, often a lot of them have December board and committee meetings. And this is a topic of conversation that's already been started. They've been modeling this performance. They're showing their committees what it looks like, and hey, do we have the right CSM? But don't panic if you're not at that stage, right? You still have some time. You just really need to get started on it.
Right.
So we talked about the pay versus performance table. So as a companion to that, the SEC is requiring that there be a clear description of the relationships that are presented in that table. So the relationships between each of the financial performance measures included in the table and the compensation actually paid, and the relationship between the company's TSR and its peer group TSR. And just please note, companies have some flexibility as to what format they're going to use, whether it's narrative, graphical, or a combination of both. And I am seeing a lot of companies look towards graphs, I'm sure with the help of their compensation consultants, just to really illustrate the relationship. Now, is the relationship actually there, especially given that we're using the SEC's definition of compensation actually paid? Yeah, that's TBD, but all the more reason to go ahead and model that in advance so that no one's surprised once it comes out in the proxy statement. So the third big piece of this pay versus performance rule, there's a tabular list of the most important performance measures that the company is using. So it's an unranked tabular list of 3 to 7 of the most important financial or non-financial performance measures that are used to link executive compensation actually paid to company performance. And so there could be one list for all the NEOs, one for the CEO, and then one for the remaining NEOs, or a separate list for each NEO. And so here is an example of one where the company has decided to make one list, and you can see that the performance measures that are most important will vary depending on the position of the executive. It's kind of a nice, neat, compact list versus having multiple lists. So moving on from pay versus performance, another project that the SEC finalized this year subject to the adoption of listing standards was the adoption of final clawback rules. Now, all listed companies are subject to this rule, including foreign private issuers, EGCs, smaller reporting companies. And so there's no escape here. We're all subject to it. And while the SEC has adopted a final rule 10D1 on the clawbacks, we're still waiting for the final listing standards, but definitely in the meantime, there are things that you can do to get your board and senior management team prepared. So first of all, we would suggest that you take a look at the terms of your incentive compensation plans and individual award agreements, and make sure that they include terms that will help to enforce this clawback. And there are companies that are taking a deeper dive and evaluating the performance criteria and the related controls, right? So are you using the right performance criteria? Should you be looking at non-financial alternatives that may withstand scrutiny? And for the financial alternatives, are there correct controls so that you minimize the risk of an eventual clawback? And then, reviewing the existing clawback policy against Rule 10d1. Just a couple of notes here. The SEC is requiring that the policy be triggered both by big R restatements, which means that there's a material accounting error that requires a restatement of prior year's financial results, and also little r restatements, errors that are corrected in the current year's results. There is no fault required with the restatement, so it doesn't matter whether or not someone did something wrong in order to trigger the clawback. The clawback should cover current and former executive officers, and there is a 3-year recovery period preceding the date the company is required to prepare the accounting restatement. And so we're not going to go into the nuance here, but the SEC has thought a little bit about what triggers the recovery period. Okay, so it's going to run from the earlier of the date the company's board or officers conclude or reasonably should have concluded that the company is required to prepare an accounting restatement. Okay, so it does leave less room for manipulation. So it's the earlier of that or the date a court or a regulator has determined that the company should prepare an accounting restatement. So, this is a lot to absorb. Kimberly, what are you telling your clients to do now?
Well, I'm first telling them not to panic. And then I'm telling them that, look, they need to put this on, they need to keep this on their radar. We are recommending that they first make some real deep dives into this once the proposed listing standards come out, which will be no later than the end of February. Because once they have those, then they will, and I don't expect that they're going to be particularly, very different than what's contained in the rules, but then they will understand with respect to their applicable listing standard exactly what is going to be expected, and that will also give them a better sense of some of the timing. So once those comes out, we believe they should start, preparing, but I would not actually, we're recommending that unless they feel strongly about something, to perhaps wait to adopt before the effective listing standards come in. They do have a period between the effective date of the listing standards. They'll have 60 days. So they should be ready for that. You don't want to start that process during that 60 days because, it impacts a lot of things. But, if you start after the proposed rules come out, then you'll be well positioned so that when the final rules come out, you can double check to make sure that, what the final rules require, you will be in compliance with, and then you can adopt. But because some of these things impact so many different documents and those interact, including charters and everything else, that, that's what we are suggesting, is that they first take a breather, maybe get through your 10K and maybe your proxy, and then dive in.
Yeah, that all makes sense to me, Kimberly. Yeah, there is that 60-day period between the finalization of the listing standards and when you have to have a compliant policy. But I do think people will feel more comfortable if there's actually been some thought and preparation before that. Mm-hmm. Yeah. So, as if that, we don't have a full plate as it is with pay versus performance and with the clawbacks. The SEC is also anticipated to be finalizing its rules around 10b5-1 plans next week. So, since the adoption of Rule 10b5-1, courts, commentators, Congress, they've all been a little suspicious. They've expressed concern that the affirmative defense that's provided by 10b5-1 has actually given insiders an advantage to opportunistically trade securities on the basis of material non-public information. And so with this rulemaking, what they're trying to do is tighten up the conditions for the availability of the affirmative defenses under Rule 10b5-1 plans. And for those who are interested, the open meeting agenda, where they're going to be discussing the final rulemaking, is going to be tomorrow. Mm-hmm. So, tune in. And, if you haven't already, I'd say now's the time to accelerate your plans to educate your board and your insiders as to the new conditions that will be available for the affirmative defenses under Rule 10b5-1 trading plans. And in brief, what they're doing is they're requiring, the proposed rules require a 120-day cooling off period for arrangements for officers or directors, a 30-day cooling off period for issuers. Officers and directors would have to certify that they're not aware of material non-public information when they adopt or modify a plan. The affirmative dispense does not apply to multiple overlapping trading arrangements. You can only have single trade plans that are limited to one plan per 12-month period. And just as an overall principle, the plans have to be entered into in good faith. So, Kimberly, which of these conditions in your mind are most likely to require an adjustment to how your clients, officers, and directors think about 10b5-1 plans?
It's primarily the 120-day cooling off period, which is much longer than what people normally do. For some of the clients that I work with, sometimes it will be 30 days, but normally we're seeing 30 days as kind of the outside time period. And sometimes there's pushback from some of the executive officers who are like, well, does the rule require 30 days? And it's like, no, but really for best practices, this significantly lengthens that. So it's going to require a bit more advanced planning on the part of insiders as well as issuers if they're going to do, for a trading arrangement of their own, because that 120 days is such a significantly longer period of time. In terms of, the no material non-public information, et cetera, all of that was, already there. You were never allowed to enter into these plans while you had material non-public information. But I think it's that 120-day cooling off period that I think is going to be the most constraining. It just requires an adjustment.
Yeah, totally agree on that. So adding on the list of things to do with relation to this rulemaking, it also touches on option grant policies and insider trading policies and procedures. And so definitely good idea to get this on your board's radar sooner rather than later and have them realize the required disclosure is expected to include tabular disclosure showing option grants within 14 days of the release of material non-public information, and the market price of the underlying securities on the trading day before and after the release of such information.
So I will tell you, sorry, I'm going to interrupt on this one.
Yeah,
I had talked with one of my clients about this and I told them this one with the 14 days, he sighed and he's like, all right, well, then he says, then I think we're just going to change the dates of our grant. He says, I don't want to actually have to go through that. He says, we'll just make sure that we do our option grants like 15 days or more, before or after the release. And typically it would be before the release. It probably be after the release so that they would do it. He said, this just seems to, even though there's no material non-public information, he said, it just raises questions and concerns for investors when they may not otherwise exist. He's like, he says, I expect, and it's up to the comp committee and the board, but he says, I expect that we'll end up revising the timing of our grant dates, as you noted, to frankly have to avoid that disclosure, not because there was anything nefarious, just because, to avoid sort of any questions that come up with it. So, and we'll see what the board ultimately decides to do in that particular instance, but they were very strongly going to reconsider the timing of their grants to have to, like we said, avoid having to do, additional disclosure.
Yeah, totally. I mean, I'm completely encouraging clients right now. Hey, dust off those option grant policies, or if you don't have one yet, think about getting one in place. Because to your point, there may not be anything untoward going on, but there is going to be increased visibility around these grants and around insider trading more generally.
Right, because sometimes it's simply all about the optics.
Yeah, totally. And then, just another piece of the rulemaking has to do with some tweaks to Section 16 disclosure. So something for officers and directors to know is that going forward, they would have to disclose gifts of securities on Form 4 within 2 business days, whereas in the past, I think people are used to doing that on the Form 5 on an annual basis.
Yeah, and that might actually be something that, when as soon as these are adopted, if that is still in there, that all the Section 16 insiders may want to make them aware of it, because that is such a significant change. Because sometimes people will do their, advanced, grant planning, et cetera, and they don't anticipate that they're going to need to actually do that filing. And so I think this is something that insiders should be very clearly made aware of, so that they understand, so that they don't inadvertently end up having a late filing, which is of course a disclosable issue.
Yeah, yeah. I mean, and no one wants to have that late filing disclosure. It's not the end of the world, but from what I understand, plaintiffs' attorneys do tend to focus on that type of disclosure. So why even give them that?
Exactly.
Let's get ahead of that. So I think most of us know that the Delaware General Corporate Law was revised to authorize corporations to adopt provisions in their certificate of incorporation to eliminate or limit the monetary liability of certain corporate officers, whereas in the past, this type of liability limitation could only apply to directors. But of course, stockholder approval would be required for existing Delaware corporations in order to amend their certificates of incorporation to do this. Here we've just set out the officer group that would be, where they would be eligible for this sort of officer exculpation clause. So, it's potentially significant for sure. So the exculpation would only apply to claims for breach of the duty of care, which is similar to, but not as broad as protection for directors, because officers aren't going to be protected from derivative claims. But also realize, the exculpation doesn't apply to a number of other circumstances. So breaches of duty of loyalty, acts or omissions not in good faith, intentional misconduct, knowing violations of law, transactions where there's an improper personal benefit, as well as the derivative actions we mentioned. So as of mid-November, there have actually been 10 exculpation charter amendment proposals announced, and 6 have been acted on. And of those 6, 4 were overwhelmingly approved by shareholders, which was interesting. There were 2 that failed, but that was really because they weren't able to get enough voter participation. It wasn't because voters were necessarily against it. But I do know a lot of clients are hesitating. They're wary about putting forward a proposal like this to their shareholders. So, Kimberley, are you seeing circumstances where clients are going ahead and trying to amend their governance documents to include officer exculpation?
We're having people consider it. So far, with respect to, sometimes there are subsidiaries, et cetera. If like a lot of operations are through subsidiaries, and they can easily take care of things, add layers of exculpation at lower levels. We're seeing people easily do that because it doesn't require public shareholder approval. But right now it's still, people are still thinking about it. They're kind of mulling it over. Sometimes it depends on how their performance has been, what their history is, what they, how they believe they may be going through shareholder engagement to see what their major shareholders think of it. And that would be a crucial issue here before you decide to put it forward. It really comes back to shareholder engagement. And particularly if you have very active shareholder engagement anyway, if this is something you're considering, this might be something you want to test the waters with some of your major shareholders in terms of, a governance point.
Yeah, so that's a good segue into the next slide, which is just to say that ISS and Glass Lewis are closely evaluating these types of proposals, and they will be looking at them on a case-by-case basis. So it never hurts, once again, to connect with your major shareholders and see how they're feeling about things. But I do like the point you're making, which is there are circumstances where it does make sense now. For example, with wholly owned subsidiaries that are Delaware corporations. And hey, when the IPO market comes back, right, that'll be something to think about for their governance documents.
Yeah, I will note, as part of our standard form documents for creating Delaware entities, this is now reflected in those.
Right. Okay, well, moving on. So at the SEC Speaks conference earlier this year, the staff indicated that when they're looking at proxy statements this year, they will be taking a closer look at the board leadership structure disclosure, which is something that hasn't gotten close attention, I'd say, since its adoption. But according to Bloomberg Law, since August, the Division of Corporation Finance has sent letters to more than a dozen major companies. And they're seeking enhanced disclosure, not in the current proxy, but in future proxies about the board's leadership structure, how the experience of the chair or the lead director bears on risk oversight, and on specific board risk oversight practices. Now, I do think something that bears some attention in addition to the board leadership structure disclosure is the related risk management oversight commentary. So we've put a sample comment letter into the supplemental materials that will be circulating to you after the CLE. But some examples of the risk oversight comments that companies are getting talk about the time frame over which you evaluate risks. And I think this is a complete, this is a connect into their focus on climate risk and other risks where, the impact over the short term is dramatically different from what the long-term impact can be. Disclose whether you consult with outside advisors and experts to anticipate future threats. How does the board interact with management to address existing risks? Whether you have a chief compliance officer and how your risk oversight process aligns with your disclosure controls and procedures. Mm-hmm. So I would say for many of our clients, some incremental improvements in these areas can go a long way.
Yeah, I mean, I think it's the concept of risk oversight is one that you'll see as a common theme when we'll chat about some of the proposed rules later of sort of the cybersecurity incident disclosures, whether it's climate change. A number of these focus on how does the board oversee risk? How are they evaluating risk? Is there appropriate risk oversight? And so as you see more and more of these, it may also be worthwhile to take a look at your charters for your various committees. When you think about the main areas of risk that your company may be subject to, is it clear which committee is responsible for sort of risk oversight in different areas if that's required? Is it a general board requirement as well? So it's worth thinking about in terms of, it's sort of like a game of hot potato. It's just like you don't want to constantly be throwing something around so that no one is actually clear who is responsible for something until something like, lands and hits. And then you look around like, I don't know. I think Bob was supposed to be handling that. And so in connection with this is the concept of board oversight, risk oversight in particular is a theme that the SEC really is in many ways hitting hard on. And it is worth consideration by the board to think about how they manage risk and how they kind of divide up those responsibilities to make sure things don't fall through the cracks.
Yeah. And, Kimberly's comment there really applies to our discussion of the other rulemakings too, right? I mean, in addition to thinking about the disclosure, think about the governance side. Is your compensation committee, is your board properly focused on the clawback and its impact on 10b5-1 and trading practices? Okay, so now we're moving on to a real doozy. This is the universal proxy card discussion, which has really, been a very active discussion over the past year. And having it approved is really going to level the playing field between issuer and dissident candidates, because what it does is this Rule 14A19 requires these universal proxy cards for contested elections, which is going to allow shareholders to mix and match candidates from the company and the dissident slates without having to attend the meetings in person. So the anticipated effects: lower proxy solicitation costs because a proxy card isn't going to have to be included with each solicitation mailing. Commentators say that the universal proxies will grant even more power to proxy advisory firms because it's just going to be a real challenge for shareholders and funds to dig into each and every single candidate as opposed to assessing one slate versus the next. And in fact, ISS does intend to scrutinize candidates on an individual basis to determine, which mix of candidates are going to be best for a company. There's going to be more scrutiny then of individual directors. So are your candidates ready for this? Okay. Each party is going to be able to express support and solicit votes for other parties' individual candidates, whereas the rules prior to the universal proxy required activists to call out the company nominees that they were seeking to replace Now it's discretionary. They don't have to do that anymore. And so, the big question is, are we going to see more dissident candidates and more proxy contests? We've seen a few test cases, but a lot of it's to be determined. Kimberly, what do you think?
No, I'm not saying that there aren't a number of proxy contests and so on, but it may increase it at the margin, but these are not, some companies still have proxy access that still exists. There are requirements that you're going to be talking about that go along with it. So for someone who is sort of for someone who is a sophisticated activist, this makes it easier for them. You don't have the concept of, dueling proxy cards. But it's not, there are some still significant requirements that go along with the ability to utilize universal proxy card that I think will temper the excitement of less sophisticated activists.
Yeah, it does seem to be like it's one more tool in the toolbox of activism, along
Yes.
with, as you said, proxy access or just plain old-fashioned negotiation.
Yes.
Versus a game changer. But we'll see, right? We'll see about that. So, the things that companies should be doing now for the universal proxy, if you haven't already, consider amendments to your advance notice bylaws.
Yes.
Is there a robust process for considering providing advance notice and confirming eligibility of nominees? And there's already been quite a bit of SEC CNDI guidance and case law on the boundaries of what advance notice bylaws should look like. So first thing that you should know is that the deadlines in your advance notice bylaws will control this process. Okay, the notice by which a dissident has to tell you that they're actually going to be making a nomination. If there isn't a deadline in your bylaws, it's a default 60 days in advance of the first anniversary of last year's annual.
Yeah. So that by itself says that you need advance notice deadlines in your bylaws. Most people do have them. If you don't, this is, and if you're allowed to, depending on what your jurisdiction is, you should very, very seriously consider adopting them if you don't already have them in your bylaws.
Yeah, for sure. And then companies are also incorporating the 14A 19B notice requirements into the bylaws. For example, the dissident has to solicit at least 67% of your company's voting power. And so if you're not doing this, then you will have to disclose in the proxy that dissidents need to comply with these requirements, which is, fairly straightforward thing to do, but something to remember. There are some companies that like Alphabet and Exxon, where they're reserving the white proxy card for management use. And I think Exxon actually did this because when they had their contest with engine number one actually took the white proxy card. Now, was that an influential power play? Did that ultimately allow engine number one to succeed? Well, perhaps there's some legitimacy in having the white proxy card, but Exxon doesn't want to find out next time, so they're including in there, so something for other companies to think about. But then also, companies are revising these bylaws and they're reconsidering the eligibility and other conditions for nominees and nominating shareholders. But as the Delaware Chancery Court shows us, sometimes this can cross a line. So there is currently a case before the Chancery Court. It's Politan Capital Management, where the dissident is challenging the bylaws because they're saying that they go too far. The bylaws require that the nominating investment fund disclose its limited partners and all understandings between the fund's limited partners and any of their respective family members and cohabitants. So there is a line in Delaware case law between providing information that's helpful for other shareholders in evaluating your nominees versus doing something that restricts their franchise rights. So it's something to keep in mind. And then the other point I'd make is that if there is a situation where your company decides that it's going to reject a dissident candidate because the nomination has been invalid, that now needs to be disclosed. There has to be a brief description of the basis for that determination. If there's been litigation that's been initiated as a result of this decision, that also has to be disclosed. And you have to disclose the potential implications, which I mean, most immediately, if the court disagrees with the company and the dissident nominee is included, then you're looking at an adjourned meeting or just amending your proxy, adjourning the meeting, making sure that the process is done correctly. So, I mean, this is a lot, Kimberly. How aggressively should companies be amending their advance notice bylaws at this point?
So it's very dependent on the company. I think for most companies, they should be, reviewing their bylaws, making at least, the technical amendments to, make sure that things coordinate. Like if your bylaws talk about, exactly what the vote categories need to be, do you add a notation in there that indicates that, notwithstanding anything else in the bylaws, that always has to comply with proxy card requirements, because there have been some changes to proxy card requirements. But in terms of if you decide to go very aggressively amend your bylaws, as we said, that I think requires some very careful consideration as to, what is the purpose? If they're very concerned about activist shareholders, that's when I think you're more likely to see some of these very aggressive amendments. If it's not a significant concern for the company, then it seems unlikely to ever come up. If you want to aggressively amend your bylaws, then I think you need to, one, give yourself plenty of time to consider it. So don't just sort of throw it in front of your board and have them approve something. Make sure that you've spoken with counsel about some of the limits, some of the other challenges that are there. How is this, again, some of this goes back to optics. How are your shareholders going to look at this, especially your major shareholders, when they see the revisions that you've made? Because of course, as a public company, changes to your bylaws have to be, filed and explained. So it will be immediately apparent as to what they're doing. Are these technical amendments, or are these amendments that some of your shareholders may review as overly restrictive? So if you're going to be aggressive, and I think very, very aggressive bylaws, I think, are not for everyone. For some shareholders, it may be appropriate, but then I think you need to allot more time for some more in-depth consideration of exactly what you're asking for. So you don't simply do a cut and a paste of what somebody else did. So,
yeah, we say this all the time as lawyers, but in this case, I think it's really true, right, Kimberly? This is something that is the type of bylaw that's going to be proper for your company is just really going to depend on the circumstances and how big a risk activism is for your company. So, and the other thing I'd say is that it's much better in Delaware court's eyes to adopt these bylaws on a clear day when there isn't a proxy contest going on. So something to have a discussion with your board in advance of an actual proxy contest. Yeah. But whether or not your company decides that it wants to amend its bylaws currently, I'd say just generally for our clients, it's a great idea right now. Really strengthen your director bios. Are they up to date? Are they attuned to investor policies for tenure, qualifications, and diversity? Make sure you have a robust director nomination process that shows, hey, there was actually consideration that the incumbents should continue and that they make meaningful contributions. And review your board composition and skills matrix. They're going to continue to get a lot of attention here. So we really need to get on to the 10K, but just a couple of other things to note on the proxy side. First of all, the universal proxy card rules do have some requirements about clarifying the voting options that you present on your proxy card and in your proxy statement. And this is historically something that plaintiffs' attorneys focus on. It's technical, but you need to get it right. So please, take a look at that this year. Make sure that when you have a majority voting standard, there is an option to vote against and abstain. It's a plurality that you have that withhold properly disclosed. Make sure that your proxy statement is properly disclosing how votes will be counted and the effect of the withhold vote. Stay on frequency. So if you last had your vote in 2017, now's the time to include that again. And seeing whether the say on pay vote should occur every 1, 2, or 3 years. And last year, the SEC also adopted amendments to its Regulation ST. And the most immediate impact for those preparing for the annual reporting season is that you will be needing to submit a PDF of your annual report into Edgar. Okay, they won't be accepting paper delivery on this anymore. And then, there's also electronic filing requirements later in 2023 for Form 144s, and then in 3 years using XBRL tagging for your Form 11Ks. And with that, I'd like to turn it over to Kimberley to talk about developments in our 10K disclosure.
So these are not new rules. We don't have changes to the rules. This is more a matter of, given the current choppy market, increase in inflation, increasing interest rates, the ongoing conflict in Ukraine, we just wanted to take a moment to kind of go through things to make sure that when you're going through things that you sort of keep things in mind that we've been thinking about. So first, we want to talk about risk factors. Look, risk factors are kind of like popcorn that sits out, in a bowl on the shelf. Yeah, it can go stale really, really fast. I will note it never stops me from eating stale popcorn, but nonetheless, when it comes to risk factors, you should read them every single year. And that means every page. So it's amazing. Like sometimes you'll note that, you put a comment in that related to something, and then you're like, oh, that was 2 years ago. So make sure you read them. And so let's talk about the structure of the risk factor disclosure. If it exceeds 15 pages, you need to put in the risk factor summary. It has to be, concise, bullet point. If you do this, most people would put it in their forward-looking statements paragraph in the beginning. And so many times people have that anyway as a way to sort of summarize those factors to help beef up that risk factor, the forward-looking statements paragraph. You should organize it logically with appropriate subheadings. So, and then while not required, it's always the best practice to list the most material risk factors first. In other words, people's eyes are going to glaze. Make sure they see the things you're most worried about before their eyes glaze. And the SEC really doesn't want to see boilerplate risk factors. If this is a risk factor that applies to every single public company out there, but you just can't bring yourself to actually get rid of it, throw it at the end. And here's the thing: if it keeps you up at night with worry about the company, not about the boy your daughter is dating, et cetera, but the things that keep you up at night with respect to the company, if you're worried about it, if your executives are worried about it, there should be a risk factor. And if there's not a risk factor already, put one in. And if the risk factor you have is incredibly sort of high level and generic with respect to an issue that you're seeing more and you have more concerns about, it's time to really look at that risk factor again to make it more specific or more specifically highlight the risk. Next slide.
Yeah, I'm having problems. Oh, here we go.
Oh, okay, there we go. All right, so let's talk about risk factors to consider. Everybody drafted a million COVID risk factors. For some of the clients that I work with, that I have the privilege of working with, this is still an issue. Many times, depending on where their operations are, et cetera. Sometimes if they have operations in China, there are some significant lockdown issues that are still in existence. So it may be a risk for you still, but for many others, these risks have receded. So it really is time to really revisit these, decide, is it still a material risk? If there's, if COVID itself is not a risk, but just kind of like the lingering after effects, it may be that your risk factors should focus on the after effects as opposed to sort of labeling it COVID-19 at this point. Inflation. Has it had a material impact on operating costs? I mean, and that goes there for everything to raw materials, fuel, transportation, labor costs, et cetera. Just, is inflation taking a toll? Interest rates. Now, everybody knows you're going to have your disclosure in the single worst section of the 10K to write. Everybody knows this is the worst section to write, is the quantitative and qualitative disclosures about market risk. It is also, I think, the very longest description of all the items in the 10K in Reg SK. But consider whether a risk factor makes sense. Are interest rates going to be posing a concern with respect to your ability to borrow? If you typically tend to fund through debt issuances, is this going to create a problem for you? Ukraine. The SEC issued a sample letter in 2020, a sample comment letter, giving people, encouraging more detailed description. And as the war in Ukraine continues, the effects, which may have been minimal in the beginning, may be more and more severe. And that includes things like, if you're doing business in Russia, Belarus, or Ukraine, do you rely on goods sourced from those countries? Supply chain distributions. My mom's looking for a new car, and her brother told her not to buy 4 different kinds of cars because everything is sourced out of Ukraine. So she took those cars off her list. So just different things like, supply chain, do you have relationships? Do you have assets in these countries that, may be problematic? And then Inflation Reduction Act. Consider if any of the provisions in there might have a material impact on the company. There's a 1% excise tax on stock buybacks. There's different things with respect to investments in climate protection, tax credits for various things, investment in clean energy production, and so on. So do any of those, or are you looking at any of those? So the question is, is there any impact on those that you consider a risk? Oh, and if it's something that it's only going to be great for you, that's not a risk. Other things to consider, which we're going to jump into: ESG, climate change, cybersecurity, human capital management. Next slide, please. All right, so these are not new. Like I said, Cam had the interesting part of today's presentation. So, but what I do want to point out is that on MD&A, as you know, you really do need to discuss, known trends. You have to focus on material events and uncertainties known to managements that are reasonably likely to cause reported financial information not to be necessarily indicative of future operating results. In other words, what might change. So particularly when you consider the choppy markets, the concern about the potentially slowing economy, this is something you really need to focus on this year in MD&A. MD&A is going to get there's going to be a significant focus on MD&A. Liquidity. Analyze your company's ability to generate and obtain the cash that you're going to need, both the short term and the long term. So in other words, next 12 months and then longer than 12 months. And you need to do those separately. Capital resources. It's the mix of how you're going to be raising capital, if you need to raise capital, is based on reasonably likely material changes in the mix. So in other words, if interest rates are going up, are you going to go to the equity markets? If the equity markets are very choppy, are you going to, have to look at the debt markets regardless of the higher interest rates? These are things to think about and focus. So if you have typically had the same paragraph over and over again, really look at it and think about it. Maybe it doesn't require change, but it really is something that I think you should consider focusing on, given all of the things that are currently going on in the market. Next slide. Oh, and before I go on, the SEC is very clearly focused on non-GAAP information again. They just issued this morning some additional guidance on non-GAAP information, including commentary like, well, even if you provide extensive disclosure on the non-GAAP measures, it can still be materially misleading. So, and it went through a whole bunch of measures of what equal prominence means. Again, nothing that is a surprise, but the fact that the SEC decided to issue more guidance on non-GAAP numbers shows their continued focus on non-GAAP. So if you use non-GAAP numbers in your 10K, be very, very careful to make sure that, one, the GAAP numbers are always more prominent. And when the SEC says equal prominence, they mean more prominent. So just read SEC speak as saying it has to be more prominent than your non-GAAP, and try to put in very clear discussion, because it's very clear the SEC is focusing on non-GAAP information. All right, climate change, because we have 5 minutes, I'm effectively going to cut this down to 1 minute. I expect that this is going to get passed in the first 3 to 4 months of 2023. I could be completely wrong. It took them 2 years to get through from the proposed to final rules on mining rules, but it is clear that Gensler really, really wants these in, and they're very focused on this. They had like over 4,000 unique comments, a lot of form letter comments. The rules are extremely complex. The one nice thing about some of the delays in getting it adopted is that I'm guessing that it means that there's going to be more time for companies to adapt to this. I mostly put this in here because I really like that picture. No, you can go ahead, Cam. This is going to require things like, for many companies, everybody's going to have to scope 1 and scope 2. Certain filers will also have to do scope 3. There will eventually be attestation, which I think for every environmental consultant and every accounting firm out there, they saw these and they started to salivate because they knew that this meant more fees. Because these are going to be expensive, attestation is going to be required, and somebody's going to have to do it. Next slide, please. So implementation, again, very, very briefly, as these move forward, for some companies, this is more onerous than others, but the board is going to have to figure out, like, what do you currently do? What do you currently report on GHG emissions? It could be that you already, for companies like mining companies, I do a lot of work with mining companies, they already do quite a bit of reporting to the EPA. But, what is your gap analysis? What else will you have to report? The reporting is going to be much faster. Are you, who's responsible for the risk? It's like, in other words, how are you identifying your risks, which are, both, acute and chronic. In other words, hurricane versus water shortage. Think about it that way. Are there performance targets when you're, looking at performance targets that might be related to climate change targets? I strongly recommend that if you currently have a whole lot of targets that you have, that you be very careful if you really want to keep those targets, because it's going to trigger a lot of disclosure relating to those targets that you may not currently have. Next slide. Do you have any carbon offsets, renewable energy credits? You're going to need to look at your disclosure controls and internal controls. But let's wait for this to happen, and then we can all start to panic. So next slide. All right, cybersecurity. These have been proposed but not yet adopted. The SEC has been very focused on this. If you have a cybersecurity incident, I strongly recommend that you go back and look at the proposed rules that came out in March 2022, because they're really quite good. They kind of outline what the SEC is expecting to see if you have a cybersecurity incident. There'll be current reporting about an incident on Form 8K. They are going to want to understand your policies and procedures. Again, management's role in helping implement cybersecurity policies and procedures. And again, board of directors expertise. As again, these are not yet in place, but keep in mind, this goes back to the concept of risk oversight that we were discussing. And then they want updates on previously reported material cybersecurity events. So this isn't going to be this is not going to be a one and done of, oh, it happened. There will be ongoing disclosure so that you can help the market understand, with respect to your company, what that impact was. Next slide. Human capital management. This is the fuzziest requirement in Reg SK, in my personal opinion. You can throw anything in this hat. So, but a couple of things you should be aware of. Be prepared for more civil rights audit requests and more diversity reporting requests. They're not always passing, but support is increasing. And I do think that people are going to continue to focus on this area. But absent shareholder proposals, will a slowing economy, is it going to lead to layoffs? Do you have labor shortages that are going to continue, or in some area and some aspect? Even if you're doing layoffs over here, do you still have a shortage over here in a critical area? Have you been changing policies relating to employee retention? Have you had increased costs due to turnover, increased labor costs, additional costs because of retention? Are you struggling with equity awards? Because now if your stock price has been going down or fluctuating wildly, are equity awards a less valuable tool related to retention? So you have to, if you're rethinking that. Diversity, equity, and inclusion initiatives. All of these things go into human capital management. Now, on some of them, if there's concerns with the company, particularly with respect to labor shortages or increased costs, we would expect this will also be in your MD&A. And if it's not, you should consider that. But when you're thinking about human capital management, try to think of it as a very holistic question of describing to the market what you are doing with respect to your human capital. Like as a law firm, all of our assets leave the building every day, or our primary assets go home every day. And so human capital management is critical for most companies. And so this is the time to explain to people what's going on with yours. And I think that may be it. Next slide. Happy holidays. And we ran 1 minute over, so our apologies.
Thank you, Kimberly. Thank you, everyone, for attending. Hope to see you in the new year. Take care.
Take care. Bye-bye.